Hey, Kelly, how are you?
I'm good. So tell me why you think that a soft landing is not something people should be necessarily counting on right now.
Well, if you look at the last three instances of soft landings that Chair Powell referenced in his speech this week, 1965, 1984, 1994, the circumstances are just very different today. First of all, in those instances, they were trying to keep inflation from going up. This time, we're actually trying to push it down because at 5%, it's way above where the Fed wants it to be. So that's number one. Number two, by a lot of measures, the labor market is tighter. At 3.8%, the unemployment rate is lower than it's ever been at the start of any Fed tightening, except for one, which did end in a recession. And the final point, which I think is really key, is look at real interest rates. The federal funds rate is, 2 to 3 percentage points below inflation. Bond yields are negative in real terms. Monetary policy is just way more stimulative than it was at the starts of those other episodes. So the way I would put it, Kelly, is that you have an economy that is already traveling above the speed limit, and the Fed, far from applying the brakes, still has its foot on the gas. Trying to reverse that process is not one that I think bodes well for a smooth, soft landing.
You know, the market reaction, at least in the past couple of weeks, has been encouraging, though, wouldn't you say? I mean, I was shocked that it wasn't more concerned about what Powell said at the press conference and then even what he said at NABE this week, when he just flat out talks about, if we need to, we'll raise half a point and, we could go above neutral and markets are taking it in stride, aren't they?
Well, they are, but I'd say a couple of things, Kelly. First of all, in their view, neutral is 2.8%, which actually isn't very high. And if inflation ends up more like 3% instead of 2%, and there's a good case that it will be, then that's still negative in real terms. So if they go a little bit above that to say 4%, 1%, which would be 1% in real terms, that's nothing to get too worried about. And the other point I'd make, Kelly, and this is really key, is that inflation is a two-way street. If it drives up interest rates, that's bad, but it also flows to the bottom line. A second ago, you were talking about General Mills. One of the reasons they raised guidance today is pricing power. If you can raise prices, in other words, if inflation is going up at the same time as interest rates, you don't really worry that much. So stock valuations, in some sense, are a little bit immune to higher nominal rates as long as they're compensated by inflation. But that's exactly the set of circumstances that the Fed cannot allow to persist, because if you're not getting real interest rates higher, you're not applying the brakes.
You use a phrase in your piece that Bill Lee used when we talked to him yesterday. He was skeptical that the Fed could achieve an immaculate disinflation, which is something that you are looking at as well. I mean, why is that outcome so unrealistic? And what are the trade-offs from fighting to pull down inflation?
Well, you're familiar with the Phillips curve, right, which is this age-old relationship that says when the unemployment rate is high, inflation is low, and so when inflation is low, unemployment is high. And what that tells you is that both in theory and the Fed's models and historically, that if you start out with very high inflation, getting it down requires higher unemployment. It's not pleasant, but that is more or less how the models work. The Fed doesn't see that. They seem to think you can get from 5% inflation now to a little over 2% without any rise in unemployment. That's what we mean by immaculate disinflation. The argument sort of goes as follows. We have some supply disruptions. They'll work their way through the system. More people will flood back into the labor market as the pandemic recedes. That will hold down wages. And inflation expectations, which influences people's actual behavior, are still anchored at 2%. Look, I want to give them some credit. All those facts are true, and they all may yet work out. Moreover, it's still actually kind of the consensus on Wall Street that it will work out. I'm just saying that historically it hasn't. Historically, if you are trying to get inflation that's too high down to something lower, you've needed to put pressure on the economy, and unemployment has tended to rise. And every time unemployment has risen by at least half a percentage point, you get a recession.
Yeah.